Yes, now you can proceed with group accounts, and we learned on several issues, including computation of goodwill. But for goodwill, we only went on the detailed computation of the investment cost or purchase what consideration. Here, this
Consideration.
we have
Yes.
dealt with this so far. So the next thing is we are going to deal with the computation of fair value of identifiable net assets at acquisition. These net assets are the net assets of the subsidiary because that's what the parent is going to acquire, right? And the purchase consideration
Yes.
is what the acquirer is going to pay. So they should be in the books of the parent. So purchase consideration in the books of the parent, but net assets are the equity of what? Of the subsidiary, okay? Now let's go
Yes.
compute that one for the subsidiary. So how to deal with it, right? I told you that net assets
Yes.
equity. So you go and take the carrying amount of equity in the books. After getting that, maybe share capital,
Yes.
premium and other component of equity, for example, and retain the earnings, of course. And then you make adjustments because net assets means equity, and equity equals assets minus liabilities. So you get the fair value of assets and what? And liabilities, right?
And liability.
Yes, and if maybe you have this goodwill, which was already in the books, you remove it because it would actually be reflected in the new goodwill, right? So this is
Okay.
hard to deal with. Okay, let's go to the computation. Let's go to the computation now. Question number 2. Okay, what does it say?
Okay.
The requirement, it says, what is the fair value of S's identifiable and net assets at the acquisition date? Remember, goodwill is computed on acquisition. It is computed on the date the parent obtains control over its subsidiary. Right. Okay.
Okay.
Question says pre-purchase 60% of the shares of S. This is good. See question 1 or above. Okay. So it seems that this is just a continuation, right, of the question 1. Of course, question 1 said uh, P acquired some shares in what? In S, right? So
Yes.
it's
Yes.
a continuation of the question number 1. Okay, no problem. Then you are told at the acquisition date, S had the share capital of $10,000 and retained the earnings of how much? $190,000.
190,000.
So that the components of equity, so you are provided with the information on equity, right?
Yes. Yes.
Mm. So you would have it ready, and then we can. Okay, I think there's no need to go through all this. We should just do something else. Wait, let's do this. Let us go to that question of ours. Ah, shit. You know what? No, I did something today. I tried today. I tried to act as if I tried to presume what I would have done in case I meet someone who has forgotten their password, their Windows password, their computer's password. So I tried it on my laptop. And when I did it, actually, these Windows now they are better secured. The accounts were automatically logged out. So let me do this.
Okay.
Mm-hmm. Okay, I think now. Validation number 1. Yes, I think we have to proceed with what we had done before. Okay. So, at this point, oh,
Yes, sir.
Of course, well, when you can't hear, you have to say, right? When you can't hear, just say, I can't hear.
Yeah, okay, sir.
So fair value of net what? Fair value of net
Net
asset
assets
acquisition. We need it at the date of what? The date of acquisition, just like
of
that.
acquisition.
Yes. So, like you can see, first of all, we need the equity at its carrying amount, not at its fair value. So we are provided with the figures from the question. We had the share capital, but also we had the retained what?
Yes.
Retained earnings.
Retain the earnings.
Yes. So we just write there, retained earnings, and then we go for them. Here we go to our question. We have been told that share capital 10,000 and retained earnings 190. Right. So we have the share capital
Yes.
1,000, retained earnings 100 and what? 90. Yeah,
90,000.
it's just like that. So after getting that, what you just need to do is just proceed. You just proceed with further explanations, and then you adjust now. Okay. Now, going back to the question, you are told the property, plant, and equipment of S includes land with a carrying value of 40,000, but a fair value of how much?
110.
Yes. You can see now. Okay, because from the books we took this figure. These are the carrying amount in the books, right? But we need
Okay.
fair value, not the carrying amount. So you can see, okay, equity equals to assets minus liabilities. But now, so when the assets increase, it means the net assets also increase, right? When the assets decrease, the net assets do what? Decrease too.
Increases.
Opposite to the liabilities. When liabilities increase, it means equity will go down because equity equals to assets minus what? Minus liability. So the
Minus liability.
carrying amount is 40,000, but the fair value is 110. It means there is a fair value uplift of how much?
Yes. Of 70.
So you could say here fair value what? Adjustment. Fair value adjustment. So first of all, we'll have the adjustment on what? PPE, which should be
PPE.
like 110 minus
Minus 4,000.
how much are you going to get? 70.
70,000. Yes.
Yes. Look, it's positive because it's an asset, it increases, right? So the value goes up, and so in
Okay.
the net assets increase. So by double entry here, look, these ones we copied, but here we did something which is not always in the books. So we
Okay.
increase the equity by 7. Equity as a credit nature. So this is equity, remember, it's like we have credited equity, and so we go and debit PPE. So if we are preparing the financial statement, you would have gone to PPE and add this 70, right? Okay,
Okay.
that's cool. Okay,
Yes,
now we
sir.
proceed. We are told included within the intangible assets of S is goodwill of $10,000, which arose on the purchase of trade and assets of a sole trader business. Okay, so it means maybe S, when operating, actually, it once acquired the sole trader, right? And so it had a purchased goodwill.
Okay.
And as the explanation said,
Okay.
if you find that the company being acquired had a goodwill, that goodwill has to be what? Removed.
To be present.
Yes.
Okay.
So okay, but
Yes.
that's not a fair value adjustment. So I won't put it as fair value adjustment. Let me write it down here and just write goodwill. Goodwill, right. So I'm going to eliminate the
Okay.
goodwill. It was worth how much? It was 10,000.
10,000.
Okay. So we have 10, 1, 2, 3. $10,000. That's good. Okay. And then going back here, we have, so in that case, it will be like we have reduced equity, but also go and remove that goodwill. So
Okay.
that goodwill
Yes.
shouldn't be in the books. Yes. And then we are told S has an
Okay.
internal generated brand that is not recognized. Remember, is by 38 intangible assets. Internally generated intangible assets usually are not recognized. Right, maybe except
Yes.
for the common one, which is research and development. Of course, we'll be developing something, right? But others usually are not what recognized,
Yes.
because usually they do not meet
Recognize.
the criteria for recognition. So when you're dealing with consolidation, even if something wasn't recognized under 38, in this case here, you recognize it, right? This is what you do. You have to understand
Okay.
now, because you know here we want to value a company that is going to be sold, and so if we believe that
Okay.
even if the asset has not met criteria for recognition, but it could actually tempt the acquirer, it could tempt actually the seller to raise the price, right? Even though the asset has not met criteria for what? For recognition.
Okay.
So that's why you have to recognize it here
For
at its
recognition.
fair value, yes. So we are told the directors of P,
Okay.
if that this brand has a fair value of how much? 150. You see,
150.
also going to the fair for the fair value what? Adjustment. This too is an adjustment brand, right? Okay, is it going up or down?
Okay.
Going up because initially it wasn't there.
Going.
So yes, so it's like 1050
Yes,
minus,
it's going up.
yes, minus zero because it wasn't there. We remember, you don't copy the figure, you don't take the fair value as it is. You deduct the carrying amount because we are not only doing the adjustment,
Okay.
but it had no value. So you'd say, okay, so all of 150 will have to appear, right? And you have to be
Yes.
careful. In case maybe there is the value goes down, the value of an asset goes down, you have to put the negative here. So you have to be careful on that. So as
Yes.
usual, you adjusted the
Okay.
equity. You'd also have to go to the statement of financial position and add the brand there. That's that way.
Okay.
You go on. Okay, here we are told in accordance with I-37, which is provisions, contingent liabilities, and contingent assets, the financial statements of S disclose the fact that a customer has initiated legal proceedings against them. You see? So the company maybe could be liable to pay something. Now you're told if the customer wins,
Yes.
which lawyers have advised is unlikely. Okay, you see. It means
Yes.
the chance of the company being liable and do the settlement is remote. So this is kind of maybe at,
Yes.
at the very least a contingent liability, or maybe even not anything, right? Even if it is a contingent liability,
Yes.
for example, okay, maybe that's the case. Estimated damages could be 1 million, right? But in case the
Yes.
customer wins it, so it means if the company is actually liable, it would have to pay 1 million. But we have been told it is unlikely, so the company you won't record this 1 million, right? Because it just
Okay.
be
Yes.
a what liability. Also, the fair value of this contingent liability have been assessed is 120,000 at the acquisition date. So you see, so is at the acquisition date, the fair value of this contingent liability is how much? Is 100 and what? And the 20. So
120.
you see now, usually we don't record the contingent liability, but for consolidation purpose, you do record it. You get the point? Because here
Okay.
we just need to get
Okay.
the fair value of something are going to be sold, right? So
Okay. Yes.
come here and write contingent what? Contingent,
Liability.
yes, liability of how much? It was 120. Okay.
120.
What does the liability do to equity? Does it increase equity or reduce equity?
It reduces, so we subtract.
Yes, you see that. So it's very simple. You just do that.
Yes.
Yes. And then you go on and proceed. You're told the directors of P wish to close one of the divisions of S. It is in this restructuring, restructuring provision. They estimate that
Hmm.
this will cost 180 in redundant payments, right? Of course, this won't be
Yes.
recognized because they just wish, it's a wish, right? In order to deal
They're
with those
estimating.
restructuring provisions and what, the management of the company should show that they are ready, they are committed to do that, right?
Yes.
Yes, they should prove that they're committed to do what? To do that. But also, even those people who are going to be taken off, to be laid off by the company, should also be aware of that. But we just want the company just pushing to do that.
I can't hear you.
I'm saying that in this case, the company just wishes to do that, right? So the criteria for
Yes.
recognition of a provision wouldn't be there, so you can record anything, right? So it's just
Okay. Okay.
are told what is the fair value of the identifiable net assets. So it will just be over just like that. I could just let me remove this row, this one here, and okay, let's get the total. Let's just get our figure here. How much would it be?
Okay.
Okay, so I'll just have to sum them, right? Sum, they'll just come natural. Okay, so I'm going to get 290,000, right? You see, so
Okay.
we have all of net what? Net assets. We are done with
Net
it.
assets.
Now, when you're going to do the
Okay.
actual question, remember you have to prepare the net assets at the acquisition and at the reporting date. And when you prepare the reporting date, things like PE, which have depreciation, you will write their figures, but also you have to write their accumulated depreciations, right? So you have an additional line down, line
Okay.
get the accumulated what? Depreciation. So just beware of that.
Depreciation.
Yes.
Okay.
So I think we are ready on as for Goodwill, you already have the purchase consideration on the first question. We already have the fair value of the identifiable net asset at the acquisition. What we need next, the net non-controlling what? Interest at the acquisition. And that's
Interest.
what we're going to do. Right.
Okay.
Let's just go back at the top.
Okay. Thank you. I did question 2. If you go to
Okay.
now I understand. If
Yes,
you
you
go
told.
to consolidate, yes, console 2, I added goodwill. I think this is why. Now I understand that the
How
goodwill that we find has to be eliminated. Yes.
yes, it should have been 290. Yes, if you do it,
Yes.
there's negative, it's
Okay.
fine. That's great. Just as good.
Okay. Yeah.
Okay.
Okay. Okay.
It's like you are almost acing the question. It was just a little. You see.
Yes. Just some little things to catch up.
Sure. Okay, now we need to get the non-controlling what? Interest. Non-controlling interest is that
Okay.
percentage of shares that the parent doesn't have control of. You own 85% maybe, and 15% is owned by others. So it is of no
Okay.
concern to you how to break down that. Maybe it's their share capital, their share premium, I don't know, their revaluation surplus, their return. You don't care about that. You just need a single combined figure, right?
Okay.
So you go to non-controlling what? Interest. Okay.
Interest.
You have two ways now of computing the non-controlling what? Interest.
Interest.
Of course, the first one is direct, it's too direct, but actually it's not preferred. We prefer the second, right? So non-controlling interest is a
Okay.
of fair value of net assets at acquisition. This one is simple, just like I've been told you. After getting the fair value of net asset at acquisition, if you acquire the 80% of the subsidiary, it means 20% is not yours. So just go and take 20% of the net assets, and you'll be done, right? Just like let's just take
Okay.
you see the question we have just solved. In case we needed to obtain the non-controlling what? Non-controlling interest. Like I told you, we have
Interest.
we have the first method, which just takes the proportion of net what? Proportion of fair value of net
Net.
asset. It's simple. You
Yes.
could just say, okay. Remember, the question said that the company acquired 60%, right, of the subsidiary.
Yes.
So the non-controlling
Yes.
interest, what percent? 40, right?
40%.
100% minus
Yes.
60%. So you just multiply by your fair
40%.
value of net assets. You get that. You see that. So it's just as simple as that.
Yes.
So you should just do that and everything will be all
Your
right.
computer is in Swahili.
Yeah.
Your laptop is in Swahili.
Ah. Well, you're looking at the title bar. You're looking at the title bar. You need to change something and you don't understand.
Yes, I've been observing.
I don't know why it's this way. So I said, ask myself, what is this?
Okay.
What is this? What is this? What do because it
Yeah.
can confuse sometimes. It can confuse.
Hello?
Yes, yes, I can hear you. I can hear you. You
Ye-
hear me?
Yes, now I can hear you.
You know, this browser, I'm just trying to check. Trying to change I'm looking for the translation button. I can't see the translation button. Where?
Okay. No, but it's fine. Since
Yes,
you are
yes.
not using the top bars. Yeah, it's fine. I just asked you the language.
I say, what is this? I don't get this. What is this language? So you had to presume. Okay, so
Okay.
this is how we get the non-controlling interest by the first method, 116, right? But also
Yes.
we have the second method. The second what? Method that
Method.
we get the fair value of non-controlling interest. So it is non-controlling interest at what? At the fair value. You have to get the difference.
Okay.
Sometimes people say, okay, why they are both at fair value, but it's not. Look here. This is non-controlling interest as a proportion of net assets. But remember, net assets are usually measured at fair value. That's why the word fair value appears, right?
Okay. Yes.
Yeah. But here, this is NCI at fair value. That NCI itself is at fair value, right?
Okay. Okay.
Yes. So you
Yes.
can see for this case, just say NCI equals to NCI percentage times the fair value of net assets at acquisition. And look here, this gives a proportionate goodwill. Remember, non-controlling interest is used to get goodwill, right? It is added to purchase
Yes.
consideration and we deduct net assets. Now you can see,
Okay.
so if you have two ways of computing non-controlling interest, it means you could also have two goodwill, right? Two different goodwills.
Okay.
Yes. And now you have to remember, when this NCI is measured as the proportionate of fair value of net assets, right? Know that the
Yes.
goodwill obtained is only related to parent. Remember, maybe as a parent, you are owning 60%, and the
Yes.
non-controlling interest, they are owning 40%, right? So if you just take
Yes.
this the proportionate method, by the proportionate method, that goodwill will only be related to the parent. It would have nothing to do with the what? With the non-controlling interest.
The non-controlling interest.
Yes. But that's why you say we call it proportionate what? Goodwill.
Goodwill.
Or sometimes we call it partial goodwill. Partial what? Goodwill. This one is
Okay.
very, very
Goodwill.
important to get it. It gives partial what? Goodwill. It
Goodwill.
only relates to the parent. Okay. And then we have the non-controlling interest at fair value. You see this. Now at fair value, it's simple,
Yes.
Yes, when you're told about fair value, we actually use the fair value of the shares of that
Okay.
non-controlling interest. And remember, by that non-controlling interest, it will be of those companies owning the remaining percent. And so, to simplify
Yes.
matter, for the sake of exams, instead of considering those non-controlling interest companies, we go to the subsidiary and take the fair value of the what? Of the subsidiary,
Of the
right?
subsidiary.
Yes. So see, this
Okay.
is what you do. You say, okay, maybe I'm owning maybe I'm owning 60,000 shares and maybe 40,000 shares are owned by others, right?
Yes.
You take those 40,000 shares and this is the formula to get, right? Presume maybe a company
Okay.
has 100,000 shares and you are going to own and you are owning 60%. It means 40% are not yours, right?
Okay.
So
Yes.
the shares you're not owning, you would say 40% and the total shares in a subsidiary, right? And in this case, you would
Yes.
get the shares which you do not control as a parent. So after getting those shares, you just multiply by the fair value of shares of that what? Of that subsidiary. And
A
doing this
subsidiary.
give you the fair value of non-controlling interest. This gives a full what? Goodwill. Or goodwill, meaning
Goodwill.
that this goodwill is for both the parent and the non-controlling interest. Do not use the word subsidiary. Just write your subsidiary to match with this one, but you should not say the word what? Subsidiary. Right.
Okay.
So you say
Okay.
that this should relate to the parent and non-controlling what? Interest. You know,
Interest.
when you do the consolidation, we need to get the parent interest, what we own, and the non-controlling what? And the
Interest.
non-controlling interest. So the parent interest is what we have, and the non-controlling interest is what others have over the same company. So we are still sharing the same subsidiary, but the parent interest is the percentage you own in subsidiary.
Ah,
And
you've gone.
I mean, is the parent interest is the percentage you own in the subsidiary, is the parent, which was 60%, right? And the non-controlling interest, the
Yes.
percent others own on that. So speak of the parent interest and
Okay.
non-controlling interest. And be aware of these words. Instead of parent interest, when they write their group means the parent what? Interest. Because when you speak of the group, it means
Interest.
the parent and that proportional share
The
that the parent owns.
subsidiaries.
Yes, but the percentage of share that the parent owns, right? Parent interest and the group presume the
Yes.
same thing when you do study, right? So
Okay. Yes,
I
sir.
could remove this word, this subsidiary here. That's what we're going to do. So maybe let's go to the question, that question of ours, and compute the non-controlling interest at fair value now. This one. 3 says, following on question 1 and 2, above, calculate the goodwill arising on the acquisition of S if the non-controlling interest at the acquisition date is valued at what? Fair value and proportionate.
Fair
Okay,
value.
proportionate, we just got an NCI, so it's either to get the goodwill, but no problem. Let's just get the fair value first of NCI, right? Fair value, Roman 1.
Okay.
Fair value, where the fair NCI now is measured at fair what? Fair value, where the fair value of
Fair
S
value.
share value of fair value of the subsidiaries shares is actually how much? $1.3 per share.
1.3.
2018. Remember, this was the date of acquisition. If it's January 21, 18. This one. See.
2018.
So okay, it's 1.3. So like we said, you just have to come here and get the fair value of what? Non-controlling interest. So you ask yourself, how many shares can be attributable to non-controlling interest? What percentage? It's 40%, right? 40 per what?
40%.
Then you multiply by the total shares of the subsidiary to get the shares that the part that
1.3.
own. How many shares that the subsidiary have?
300,000.
Where did you see? Is it at question number 1? It's the same question, yeah?
Yes, 0.3.
Share exchange by 2 shares in this the P's shares had a nominal value of $1 in favor of 2.8 each, and S had a total of 3,000 what? 100 shares, right? This is good.
Yes.
Okay, so you have to
Yes.
multiply by 3 what? 100. So
300,000
it would get like 120, right? 100 and what? And 20,000
and
shares.
20.
Yes. But now what we need is the fair value of those shares, right? So we go then and multiply by the
Okay.
fair value of shares of a subsidiary, which was how much fair value? 1.3 over subsidiary.
1.3.
So I'll come here and multiply by 1 point what? 1 point,
0.3.
yes, and I would get this one. This is great. So we already have an uncontrolling interest for proportionate method, but also at fair what? At fair value. So I think until that
Okay.
point it will be easy. We can get the goodwill now. Okay, let's get our what? Our goodwill.
Goodwill.
And remember, this is a goodwill at acquisition. At what? Acquisition.
Acquisition.
Yes, and I'm repeating again, this is the goodwill at acquisition.
Acquisition.
We say that. Okay. The first one now. We said how to get the goodwill. It purchase what? Consideration. Still, let me just write PC. Purchase.
Okay.
And then we add what?
Consideration.
Controlling interest.
NCA.
What?
NCI.
At acquisition. Right.
Acquisition.
Yes. So, and
Yes.
acquisition, and then you subtract what? Fair value of net what? Asset.
Net asset.
And again at acquisition. Again, right.
Okay. Yes,
Okay,
sir.
now let's get our figures right. Let's go for the purchase consideration. I think we got it already on question one. We completed the last
And
time.
question 1 is,
It was
yes,
440,
443.
418, right?
Yes.
443, 18. Just go back. This one, 443, 418.
Yes.
But also it should be the same regardless of the nature of goodwill you need to get, whether it's full goodwill or partial goodwill, because the difference only lies on computation of NCI, right? Also,
Yes.
for net assets will also be the same. Net asset at acquisition is how much? 290
It's, yes, 290.
for both cases. So we say it's 290. So what makes the difference is an uncontrolling what? Interest. Now, for the
Interest.
proportionate method, what was the figure? 116, right? Right?
Yes.
Yes. And for
Yes.
fair value, it was how much? 156.
156.
So I think it's fine there. From that point, we can get the goodwill at acquisition. Goodwill at acquisition.
Acquisition.
Get the figure there. Yes. Okay. How much do we get here? And this, this NCI is like minus. Yeah.
Plus.
Yes, we're going to deduct this, right?
Yes.
Just, just put it on the right.
832.
What did I just do here? Different.
The NCI and the PC are supposed to be added, and then we deduct the
Mhm.
net asset.
Yes, so you go to net assets here and deduct, right?
Yes.
Go to the net assets and do what? The deduction. Okay.
And deduct.
So what are we going to get here? We have to sum our three figures, right?
Okay.
Yes, from this point, the last point, and we deduct, and I have like 269, 418.
269. Okay.
418. And then let's go to compute the goodwill at using the fair value of NCI. We would also have to sum our figures, and we would get that one. You can see. Can you see?
Okay.
That's why
Yes, I can see.
you have computed well the goodwill. This is the partial goodwill. It only relates to the parent interest. But this one relates both to the parent interest and the NCI. That's why it is much higher than this one. You see, 309 and here
Okay.
69. You see,
Yes,
yes.
sir.
So if the exam has been set well, and maybe you have to compute both of these, it of course the fair value one should be greater than
The other one.
the other one, because the fair value is called full goodwill because it is attributable to both the parent interest and non-controlling interest. While this one, the proportion one is only attributable to the parent what? Interest. So it's just that way.
Interest.
So until that point now you are very comfortable that you can get the what? The goodwill.
Okay.
I think now we can say that you have taken a step, right? You have taken a step,
Okay.
a great step. And if you go back here, of course, okay, we have looked at how to get the purchase consideration, like you have just seen, and we saw the workings, right? Let's just go back here. Just a reminder, We saw how that we have to know the group structure, and we did explain how to get the group structure working one, working two, and net assets of each subsidiary, and we are done with that. Working three of Goodwill,
Yes.
we have just computed it. Okay, now we go to
Yes.
working what? Working four. Working four. This was just the further explanations. Now we are when working four. After
Yes.
getting that, actually, what follows is, remember, when you do the consolidation, consolidation is all about breaking down the equity of the subsidiary. This is the point you should get. The equity of what?
For the subsidiary.
That's what we focus on, breaking down the equity of a subsidiary, partly into parent interest and partly into non-controlling what? Interest.
Interest.
This is the thing of we are most interested in. You should get that as far as consolidation is concerned. And that's why you can see
Okay.
the fourth working after those fundamental ones is non-controlling what? Interest.
Interest.
And after that, this is equity. After that, we'll go to the equity of the parent interest, which we call group equity. We call group what? Group.
Equity.
You could see from working four, going down, you
Okay.
would find something called working five, group reserves. You can just say group equity is fine, right? By
Okay.
getting that, everything would be fine. Maybe you just have to learn now the associate, how to deal with the associate. But everything, I think, most
Okay.
will be fine. And then we'd have the consolidated statement of comprehensive income. We could leave it first, although there is nothing much to learn, of course. Okay, I think maybe we could just go through it, but also, we could try. I think we could even skip it because we will first deal with the statement of financial position, right? So we could come to the account
Position. Yes.
of yes. So that's what.